More great news starting out in 2014. The Mortgage Forgiveness Debt Relief Act was extended once more. The act was introduced into United States Congress on September 25th, 2007 and signed into law by President George W. Bush on December 20th, 2007. This act offers relief of homeowners who would have owed taxes on forgiven mortgage debt. Now, President Obama signed the reactive extension on Mortgage Debt Forgiveness Act, but only extended the act through 2014. So any further extension of the short sale tax break would need to be reenacted by the Congress for 2015. So we'll see what happens there. The Mortgage Debt Relief Act was signed again in 2007, generally allows taxpayers to exclude income from the discharge of debt on their principal resident, debt reduced through mortgage restructuring, as well as mortgage debt forgiven in connection with foreclosures qualifies for the relief. Now, December 16th, 2014 is when President Obama signed the bill to extend it. And again, it's retroactive for 2014 mortgage debt canceled. Now, NAR reported about 5.3 million homes are still underwater. They also reported about 1 million homes in process of foreclosure. So we'll see what happens for 2015 in that debt that's getting forgiven and how that is going to affect taxes income for our homeowners in 2015. Now, let's just use an example. If you had a mortgage debt of $400,000 and you sold your house last year for $300,000, that means the debt that was forgiven by the bank was $100,000. A lot of consumers don't realize that that $100,000 is actually considered ordinary income. The bank is required to provide a 1099-C, and then you're going to pay income taxes on that forgiven debt. So if you're in a 25% tax bracket, the cost would be $25,000 that you're going to pay in additional taxes because of that debt that was forgiven. And I can't tell you how many people, this has been a conversation throughout the years since 2007, because it is always for 12 months and then it just keeps getting extended every year. And it's been a hot topic of questions from listeners from my show in trying to understand how it's going to affect them, and that they never knew that by having debt forgiven, that they were going to have that tax consequence that they were going to have to pay. So really important information, and it's really great news, again, for homeowners in 2014 that did have debt that was forgiven. Now, other ways to get out of paying the income tax on that income that was forgiven is bankruptcies. Debts discharged are not taxable. Insolvency, so total debt more than fair market value of assets. So if you had mortgage debt of $400,000, the sale price again was $300,000, the forgiven debt was $100,000. If your assets were $600,000, liability $700,000, the insolvency is $100,000. So that would protect you there. Certain farm debts, if you incur debt directly in operation of a farm, that's the first requirement. The second requirement is more than half of your income for the prior 3 years was from farming. And the third requirement was the loan was provided by an agency regularly engaged in lending. So, basically meaning if you had seller financing, that would not qualify because they're not regularly engaging in lending. But any of your mortgage banks or banks that lend, then you would meet that third requirement. And the last way to get out of paying the taxes on that forgiven debt would be non-recourse loans. Loan that the lender only remedy in the case of default is not repossess the property being financed or used as collateral, does not result in cancellation of debt income, but may have tax consequences. So the Mortgage Debt Relief Act, maximum debt under the act is $2 million for married and $1 million for single or married filing separate. It's only allowed for primary or second homes. So if you did foreclose or short sale on an investment property, you would not qualify under the act. Still report the forgiven debt even though that you're not paying taxes. So you're still reporting that, just not having to pay taxes on it if you qualify. Now, a common question is, what if you did a cash out refinance and then lost the property or had something forgiven in a modification, a principal balance forgiven in a modification? If the cash that was taken out on the property was for improvements on the home, you know how the IRS is, you have to paper trail and document pretty strongly. But if you can document that it was for improvements, then you would qualify. If the cash was taken off to pay off other debt, then you would not qualify. So as always, I'm here as a resource for you when it comes to anything regarding mortgage. That is my full-time career when I'm not doing my show here. So feel free to call the show at 1-855-400-1150. Again, that's 1-855-400-1150 or online at themoneyhour.com. And coming up next on the Money Hour, how do you find your niche, personal brand, and social media engagement? Deborah Trapin with D11 Consulting right here on 1150 AM KKNW after the short break.